Welcome to Coffee and Crypto with Lee and Jimmie. I am Lee Reiners, joined as always by Jimmie Lenz. Good morning, Jimmie.
Good morning. A nice fall morning, crisp fall morning here in Durham, North Carolina.
Chris Fall, it's been a minute since we did this show. So last week we were off because you were traveling, and you have some more travel in your immediate future. So why don't you tell our listeners where you're heading?
Heading to Money 2020. So if you're in Vegas for Money 2020, look me up. I will be there speaking on fintech and financing fintech companies. So it'll be interesting. I talk on Monday, early Monday afternoon, and I am looking forward to seeing a lot of folks there. Boy, what a big crowd! This thing draws like 20,000 people.
A lot
it's
of
crazy.
folks. A lot of folks. So
a lot of folks.
I won't be there, but you'll be carrying the Digital Assets at Duke banner.
Absolutely be carrying the torch. There are, there's so many fintech companies there. And, I started thinking about it, Lee. I was kind of sketching out the talk that I'm going to give. Everything's fintech. Everything at Money 2020. They should call it Fintech 2020.
Probably.
Yeah.
You going to do any gambling while you're there? It's Vegas.
I may play a little, a few hands of cards. May play a few hands of cards.
Just don't get into a poker game with Chauncey Billups, okay?
Yeah.
Couldn't help myself there. All right. Well, I hope it goes well. I'm sure it will.
You'll hear about it. You'll definitely hear about it.
Yeah. Let's do a debrief next Friday.
We can do a recap.
But lot to cover today, Jimmie. Always a lot to cover. Let's start with I think the biggest news for the day, right? The crypto news cycle. It's not even a 24-hour news cycle, right? But what's dominating the news right now is Donald Trump's pardon of CZ, Changpeng Zhao, the founder of the crypto exchange Binance. As I'm sure our listeners are well aware, Binance is the largest crypto exchange. They have their own blockchain, their own token. So they're the biggest player in crypto. And a few years ago, CZ and Binance pled guilty to willfully violating money laundering laws. If you read the complaint, it's pretty egregious, the conduct in there. So we don't necessarily have to revisit that. I think this was signaled, so I don't think anyone is necessarily shocked by this announcement.
Yeah, I was going to say they kind of floated some early balloons on this one.
Yeah, but I don't know. What are your? I have thoughts, but I want to get your reaction here first.
Yeah, I'm a little surprised. I must say, although there have been a lot of pardons.
That's for sure.
I mean, I don't know. Maybe this just gets lumped in with a lot of other things.
So you're saying if things get a little out of hand in Vegas, there's hope for you?
There's hope. I don't quite have that pull. I don't think. I don't know. I don't think I have that pull.
I think you do. I think you do.
It's there have been a lot of pardons. The CZ, I mean, why? I can't really figure this one out. I mean, I could see if there was.
Why? Come on, man. This is pay to play, dude.
Yeah, I suppose. But I mean, it just didn't seem. I don't know. Like I say, they floated some balloons beforehand. You kind of knew this might be coming, but still, I think it surprised even me.
Yeah, look, this is obviously not helpful to the crypto industry's efforts to mature, right? And come across as legitimate and trustworthy. And it's not helpful to their efforts to get legislation, market structure legislation, through Congress. So, I know that there are many in crypto who are not happy about this. I mean, not only obviously is Binance a competitor, right? And so
right. Yeah. I mean,
they certainly
can't forget that.
For some of them at least, right? Who don't mind seeing Binance on the sidelines in the U.S. at least, right? Because as part of the settlement, they had to shut down their U.S. operations, which I presume will be allowed to operate again here in the U.S. in the near term. But look, what the White House has said is that this was basically a corrective to Biden's war on crypto, basically. That this was a politically motivated anti-crypto prosecution, which is complete bullshit, right? I mean, it is totally false. I've never heard anyone from within the crypto industry say this at all. And all I would say is read the complaints. Complaints plural, from
Yeah.
FinCEN, from
Yeah, there
DOJ.
was more than one complaint.
Binance and CZ were willfully facilitating transactions for a literal murderer's row of the worst people and organizations in the world. Hamas, Al-Qaeda, people engaging in child sexual abuse, right? They knew this was happening. Damning quotes from Binance employees in the complaint. So this was enabling, again, the worst of the worst people out there. And now it's all gone away, at least for CZ.
Well, I
And
don't
look,
think. I mean, it's gone away,
the
but has it really gone
monitorship.
away?
Look, there's
I mean,
there's two monitors. There's two monitors.
Yeah,
A DOJ appointed monitor, which I think is going away, and then there's a FinCEN monitor, and there's some uncertainty in terms of whether the FinCEN monitor will still be there. But look, I mean, we all know the deal, right? That the UAE backed investment fund, right, bought a $2 billion stake in Binance. They pay for that stake with the World Liberty Financial stablecoin USD1, right? So that means World Liberty Financial is getting, what, 4%? What's the yield that Circle got right on reserve? So roughly 4%,
around 4. Yeah,
roughly 4% on $2 billion a year, right? Straight into World Liberty Financial and Donald Trump's pockets. I mean, this is pay to play as it gets. This is obviously corrupt. People see this for what it is. And now you have stalled momentum on market structure legislation, and you introduce something like this, and Democrats are rightfully saying, wait a second, this is blatant corruption. We need to address this in this market structure bill. This does not come across as an industry that is like worthy of our efforts here. And so, I don't think Donald Trump, frankly, cares about making the U.S. the crypto capital of the world. I think he used the industry first to get elected, and then second to get money into his own pockets. And he's frankly screwed them. Like, this is screwing the crypto industry, no doubt about it.
I do not think I don't think it supported the crypto industry for sure. Because I mean, like I said, it was kind of water under the bridge. So I don't think it is helping the industry out at all.
It makes the industry look like a bunch of grifters.
I don't know if it makes the industry. Certainly, it colors Binance that way. I don't know if it colors the industry that way, because I mean, banks are found guilty of this all the time, and we don't think of banks that way.
I don't know.
Well, maybe people do think of banks that way. I don't know.
Some do, I guess.
I mean, maybe I'm a little sheltered there. But I think that when you look at this, even very objectively, it's like, why? I mean, I know what you're going to say, but I mean, it doesn't make any sense. If you take the money out of the equation, it doesn't really make any sense.
Yeah,
I think the industry had already kind of absorbed this. I think Binance had kind of absorbed this. We were moving past it. To me, it kind of brought up something that there was really no reason to do. So it's beyond me. Honestly,
we can move on. I mean, we're in agreement. I think pretty much everyone is in agreement. Look, the crypto industry is going to bite their tongue on this because they don't want to alienate the president and be retaliated against. So that falls on us, Jimmy, to speak our mind, which we can do because we work for an academic institution, right?
We do work for an academic institution,
but
we
even
can
here,
kind of do that.
Even around here, people are a little nervous.
Hey, you know what? I wanted to let you know we got published the article that we had talked about a couple of weeks ago. We got published the
stablecoin article.
The stablecoin article is published.
Take a look, folks.
Yeah, I'll send you the link, but we should put it in the show notes.
We'll put it in the show notes.
I know
genius at work in the U.S. financial system.
Right. Genius
Congrats.
capital.
Yes. All caps.
It's I mean, on SSRN. So for people that don't know, SSRN, Social Science Research Network, it's kind of a place that people go and put drafts, academics mainly, but anybody can do it. Put drafts of papers that are in working, and they'll sometimes change the papers, and ours changed. So we published in a peer review journal, and the peers did a great job. Usually people are kind of throwing rocks at them. I think they improved the paper. My co-author and I talked about it. That they really did help us improve the context of the paper, and probably made it more readable for just people in popular press to.
Well, that helps.
Yeah, I think so. I think
Readability is important.
readability is important. I mean, academic papers, for those of you who don't read them,
They
are
don't
usually not
prioritize
readable.
readability. Yeah, I would say they
They
don't prioritize
they do
readability.
not. They do not. And we wanted this to be something that could be used as a reference by anybody. Anybody could pick it up and understand it. And so, and I think we got there. But I would love to hear,
And I
from
think it's
folks
going to be
who,
a reference for, because this
yeah,
is, I mean, the
yeah.
stablecoin, the wars are heating up. People are trying to figure out where this is going, who's going to be the winners, who's going to be the losers. And I think your paper is going to be cited a lot,
Thank you.
because it provides one perspective, which is historically how things shake out, which is the big banks always win, right?
The big banks kind of always win. That's
So,
that's how they got to be big.
yeah,
Now they
yeah,
stay
that's
big.
right. Yeah, exactly. But,
Yeah, but it was always a kind of a trying experience. But Reed Timsio, who's my co-author, and I, we really did take a lot, I think, away from it. And it's interesting. I know we're going to talk about it a little bit later this morning. There's a
well, we can talk
guy.
about it now.
Yeah, let's talk about it now.
Go ahead.
There's another paper article that is out that is talking about stablecoins and kind of the impact on the credit markets and on I think I would say on finance in general. He is an economist,
Yep.
Andrew Rodrigo
Negrinis.
Negrinis.
Is that, yeah?
Negrinis, I
Sorry,
believe.
Andrew, if we're
Andrew
butchering your,
Negrinis, I believe.
yeah.
But he's an economist. He worked he did his work at Stanford, and then he was at CFPB, and now he has kind of his own shop. But he kind of substantiates a lot of the points that we make in our paper around. And I think his is a little bit more of an opinion article, although he cites some other things. Not
Well,
us,
it's a
I
full
think.
length academic paper.
It's a full length, yes.
What I sent you was like a blog kind of summary
Right, right.
of the full paper. So we'll put the blog link in the show notes. People can read the full paper through the blog. So
I thought it was a good paper.
I was curious what you thought about that.
He
Okay, go
takes
ahead.
he takes a little bit different tack on what he's looking at. He's looking at the credit markets, and he is his thoughts around some of the things, and he draws some. I thought some kind of strange analogies. The shale boom was a little bit of a strange analogy. But he did draw quite a few points out that I thought were pretty good. Again, like us, he does talk about the possible impact on deposits, and I think that's what's going to. I think that's what we're going to see manifested probably, or let me see, potentially that's what we're going to see manifested probably. That's going to affect more people or affect more institutions than anything else. It's not so much the growth of stablecoins; it's where that growth is coming from.
Exactly.
And if it's coming from deposits, then we're going to have then it's going to change the landscape around a little bit. However, I understand now that there's a really good chance that we'll start seeing stablecoins used as collateral for different kinds of loans. Mm-hmm. And if that's the case, and if we can, if we see stablecoins accepted as collateral for all kinds of lending, so think prime brokerage lending and things like that, it could just be another form of currency that is used. So in other words, it would recirculate back into, while it not being a deposit, it would be a deposit-like amount of collateral that people can use, and it would be widely accepted.
Yeah.
And so, but it's I think it's a good paper. It's certainly worth reading and taking a look at.
Well, it's good to think about these issues, and we should all, those of us in this space, and certainly policymakers, should be thinking about these issues. I do think we need to approach this with a degree of humility, though, Jimmie. Right? The future is unknown and unknowable.
Yeah.
Right.
Well, yeah, there's so many things that are going on right now in the world. There's so many, and we live in a very dynamic environment. I mean, things move at such a quick pace that we're starting to see now, and we've seen this before. The renminbi is starting to be more assertive. Central bankers and things like that in China are starting to be more assertive about making loans in renminbi. I've seen a couple of bonds, not Chinese bonds, that have been floated denominated in renminbi. There's one that just came out of Kazakhstan, and so we are starting to see those kinds of things. So there are other currencies. Is that going to play into this? Don't know, but
Yeah.
it certainly could play into the adoption of different kinds of
Yeah.
stablecoins.
Yeah. So the bottom line is we're all trying to figure out what is the trajectory of stablecoins? How big are they going to get? How quickly will they grow? And then where will that growth come from? Right. So stablecoins gain, potential gain will be whose loss, right? And the outcome of that will depend on a number of different variables. Arguably the biggest is this interest prohibition, right? And this is a live debate right now because, as folks are well aware, the Genius Act prohibits the issuers of stablecoins from paying interest, but it doesn't prohibit third parties from paying interest. And this is something that's being debated right now in regards to market structure, with the banking lobby trying to close what they call the payment on interest loophole, right? So you can, so if you hold USDC, Circle will not pay you interest, but you can custody your USDC with Coinbase, and they will pay you what they call rewards, which, as we all know, is just the same thing as interest, right?
Right. Right.
And so if this is allowed to continue, then you're looking at something that is beyond just a means of payment to also include a store of value, right? And similar to the introduction of money funds in the 70s, they could grow quite quickly if this is allowed to proceed, right?
Absolutely.
And so
Absolutely.
the paper that, and you did this in your paper too with Reed, but what Dr. Negrinis's paper looks at is like, okay, well, if this is allowed to proceed, what will be the impact, as you said, on credit markets? Okay, because if you put $1,000 in a checking account, right, the bank can use those deposits to fund a loan. Okay, and particularly community banks, right, because community banks generally take local deposits to fund local loans. Okay. But if you take that $1,000 and instead put it in a stable coin, okay, then the issuer is going to just park those reserves right in treasuries,
In treasuries, probably. Yeah.
right? And so then it won't be available to be lent into the real economy. And so that's what he's trying to do in this paper, is just try to dimension what the impact will be on lending to the real economy. And he comes to some pretty dramatic conclusions. And I don't have the data in front of me here. But he basically says, look, we're going to see a significant decline in lending to the types of companies that community banks lend to.
Potentially.
Right. Potentially. So particularly small businesses. Right. So, and they're still going to need money. They're still going to have to access that capital somewhere. And they'll probably just do it on worse terms, like is his point. So look,
Yeah.
hypothetical, theoretical, based on a lot of assumptions. Okay, so take it for what it's worth, but it's just one way to think about what's going to happen. And I think policymakers should be thinking about the impact on credit intermediation.
Yeah, I mean, the interest payment through the loophole, we touched on in our paper, and I think you can't ignore that, right? I mean, it's a huge factor. You can't ignore that, and so you do have to, I think, make that consideration. However, there is a big however
Yes.
here.
Yes,
We
please.
are starting to see a compression of yields, right? Yields are coming down. Yields have come down significantly just in the past 12 months. We are starting to see yields come down. Once those yields are at a certain point, and I'm not going to hazard to guess what that point is, these are not going to be as attractive.
Fair.
People are not going to be, and in our paper, I mean, we kind of sketched out mathematically, that as these grow, yields will compress faster, right? We're already in an environment where where we see the administration putting pressure to drop rates on loans. Well, folks, when rates drop on anything, they drop on everything, because everything is highly correlated in the credit markets. As yields start to come down, what happens? Well, these are going to, it will as stable coins go up, there's going to be more demand for securities. When there's demand for securities, guess what? Yields go down. So all of these things kind of lead to the same place, yields compressing even more. Once yields compress to a certain point, people are going to say, well, why would I put money into a stable coin? I don't care where it is. If I'm only getting 1%, 1.5%, I'll just leave it where it is. I think this could be self-correct.
That makes sense to me. I mean, look, I've generally been a bit skeptical of this argument that stablecoins could lead to this massive deposit drain, because I think, as your paper and others have suggested, there's a lot of just ingrained advantages that banks
Yeah.
have.
Yeah.
And like the reality is that payment behavior is very sticky. For most of us in the US at least, like domestic payments like work fine, right? Like credit cards, debit cards, Zelle, Venmo. So thus far, stablecoins are the casino chips at the casino, right? I mean, they
Yeah.
work in the on-chain, they're using the on-chain economy. I know a lot of companies are working very hard to integrate stablecoins into, cross-border payments, domestic payments, but we just haven't
But
seen
so is the BIS.
and so and so are a lot of others, right? And it's not as if the big boys are just sitting on their hands. We talk about this all the time, right? We talk about JPM coin. It's not as if central banks are just sitting on their hands. So, everyone's innovating, trying to improve, which is how things should work in a market economy. And so I just, it
Absolutely.
kind of, a lot of this debate reminds me of, remember the presidential debates with Ross Perot, the giant sucking sound
The
that,
giant sucking sound. Yeah, remember those big charts on easels?
the giant. So for those of you who are too young to know what we're talking about, so during the what was that, 92?
Yeah, probably 92.
The presidential campaign featuring Ross Perot, George H.W. Bush, and Bill Clinton. There's a big debate around NAFTA, and was that the Bob Dole? Gosh, someone's going to call us out on this.
Yeah.
But anyway,
Ross Perot
was very skeptical of no, I think actually it was the first. I think it was the 92.
Okay.
Bob Dole was very skeptical of NAFTA, right? And so he would characterize, his whole point was like NAFTA was going to, lead to job losses here in America, and he called it a giant sucking sound. We're now people are talking about the giant sucking sound of deposits leaving the banking system, right? So we'll obviously keep an eye on this here. But congrats on the paper, Jimmie, and folks should check out the blog post and then the full paper from for Dr. Negrinis. Let's stick with stablecoins. Actually, combining Binance and stablecoins. This is another reason that I'm sure the crypto industry is not too pleased, because here's what's going to happen. I guarantee it is Binance US will be allowed to restart operations, and they shortly thereafter will start offering rewards on USD1, the World Liberty Financial stablecoin that gets parked at Binance. And I'm sure those rewards will be quite generous, right? And that will incentivize people to buy more USD1, which will lead to more reserve income for World Liberty Financial. And this will undercut the relationship that Circle and Coinbase has and other stablecoin issuers. So, congratulations. You're going to be in business with the president, crypto industry. All right.
Again, though, I do think that, this could be that may be, we may do a follow-up fairly quickly on how fast this could self-correct.
All right. Well, we'll see.
I think we could take the math, the calculators back out and do some math on this
math,
and figure out how
not live,
how fast
but
we'll
do it before the show. Okay.
Yeah.
So, Jimmie, we didn't do an episode last week, so we haven't had a chance to digest the pretty big and sudden market sell-off in crypto.
Yeah.
And frankly, I think we're all still sort of digesting what happened. Look, anytime you have, it's kind of like the reminiscence of the flash crash from 2010, and it took like quite a while for people to piece together what happened. So, but I think we have some preliminary insights that we can talk about here. So for those of you who aren't familiar, on October 10th, after traditional markets closed, President Trump announced on social media the imposition of 100% tariffs on all Chinese imports. Okay. Now, this is in response to China restricting the export of rare earths. And after President Trump made this announcement, crypto prices plummeted. Now, there was also some suspicious trading behavior right before the announcement. So a large Bitcoin and Ether short position was placed on, I think, Hyperliquid. And so there's some speculation that, that person had inside information. We don't know, probably never will know.
Don't know, yeah.
But nonetheless, it's an element to this story. But after the Trump's tweet, or I guess it was a True Social post, Bitcoin plunged more than 13% in an hour. Ethereum fell 17%. Dozens of altcoins briefly traded to zero on certain exchanges before snapping back. And then in total, at least, and the numbers here are a little murky, but it seems as though at least $20 billion in positions were liquidated, Jimmie,
Yeah.
across
That's
centralized and decentralized. So this was not just a centralized exchange issue or a DeFi issue. This was happening
this was happening everywhere. Yeah,
at a
everywhere that
variety
that
of
had people had positions on.
venues. Look, it gets a little technical and it's hard to explain this stuff over a podcast, but let me just do a brief explanation and turn
Yeah,
it
I
over to
mean,
you for
I think
reflections
I
here.
was going to say I think it's worth kind of explaining a little bit why this happened.
Yes. Yes. So, okay. So it seems as though the main culprit was perpetual futures. And you and I have covered perpetual futures on
Yep.
the show
Yep.
before, right? And these are the most popular form of crypto trading, okay? Primarily overseas, but most crypto trading is done via what are known as perps, right? Not spot, not spot crypto. And there's a lot of reasons why. The biggest is that they have embedded
Leverage.
leverage. Yeah. So
leverage is pretty much it.
leverage is it, right? Leverage is it. So for if you for $1 you put up as an investor, in some instances you can get 100 times leverage. So you can get $100 exposure. So it's pretty crazy. But then obviously, the whole point of leverage is that it amplifies gains, magnifies losses. So what happens then is that when a trader's position becomes under collateralized, okay, there is a series of steps that exchanges will take, right, to kind of correct that. The first is that they will just auto liquidate you. So they will sell your position, okay, to generally a market maker, right? So they'll stop you out. They'll sell your position. If they can't sell your position, then they kind of go down, right, a series of additional steps, okay? Because obviously the whole point is that the exchange wants to minimize like their losses.
They want to minimize losses. Yeah.
They want to minimize their losses, okay? So eventually you get to something known as auto deleveraging, which means that the exchange will close profitable opposing positions, right, to offset those losses because they're worried that obviously the winners.
Folks,
yeah,
I'm gonna put not a caveat, but it's just some additional information. Please. Other exchanges do this too. Regular exchanges do this too. We've seen it occur in the not too distant past, where positions were closed out, even profitable positions were closed out to help bolster the exchange.
Yeah, we have, and I think we've learned from that. So, there's a lot to unpack here, Jimmie. Look, this was a learning opportunity, I think, for all of us. We've talked about the market structure debate a lot in DC. This was a market structure event. Hopefully, this event will inform those policy
Hopefully
debates.
It'll inform. I mean, but people have to. And you and I have said this like a million times. Read the fine print. Okay, I mean, it's just like.
But sometimes though, there was like with this auto deleveraging stuff, like people didn't know, like it wasn't in the fine print. Like it was in the code, but
it was in the code. Yeah,
it wasn't disclosed in some instances.
I mean, it's kind of like, so when oil went negative a couple of years ago.
Yeah, the pandemic.
We had the exact same thing happen on the exchanges. People had positions liquidated, even profitable positions liquidated, to basically bolster the exchange.
Yeah.
And I mean, it happened prolifically. I personally know two people who were had positions closed that were their positions. They were profitable positions
during the oil debacle.
In oil.
Okay. Okay.
Yeah, I mean, these things under extraordinary events do occur, and I mean, the exchanges obviously have the right to do it because they do. The idea of this, and I've been a fan of the auto, some of the auto stops that in the past. I thought, this is something that could save an exchange. It could certainly, help protect markets by doing that, because the alternative is making margin calls. Well, in today's markets, margin calls don't work. Having a day to post margin when things are moving quickly, it would leave exchanges in a terrible, and clearinghouses in a terrible place.
Well, can we bring in an outside voice here on this?
Sure.
Because I want to get your thoughts on. Okay. I don't know if you had a chance to read it. I sent you.
I did. I looked at it briefly.
The Don Wilson.
Yeah.
So Don Wilson is the CEO and founder of DRW. So they're one of the most prominent automated market makers out there, and they operate across a number of markets.
Yeah, DRW is huge.
Yeah, they're massive. Chicago based, right? And he had, I thought, a really informative blog post that was tailored, I think, to like a general audience and sort of contrasting what happened with the crypto sell off with traditional markets, right? And as you mentioned, Jimmie, right? One of the key features of crypto exchanges is this auto liquidation, real time margining, right? So when accounts fall below a threshold, then you just get auto liquidated, which is different than
Yeah,
auto deleveraging. Okay.
yeah.
So he says, look, in traditional markets, you have what's called batch margining. So if you lose money on your derivatives position, your broker, which we call a futures commission merchant in the derivatives context, but it's essentially a broker, will, as you said, ask you to wire them some money. Okay. And they might even give you a couple days to send it. In the meantime, they will make the clearinghouse whole, because
Yeah, they have to. I mean, it's because
post
they're
Dodd-Frank,
yeah,
most derivatives are we call it centrally cleared, right? And central clearing, there's an entity that is standing in as the buyer to every seller and a seller to every buyer. So if one party to a trade, right, defaults, the clearinghouse will make the other side of the trade whole, right? Now, obviously, that exposes the clearinghouse to a lot of risk, right? And there's been a lot of debate about the systemic risk of these clearinghouses. Now, they have what's called a default waterfall, right? So if a counterparty defaults, again, a series of steps to take. The last step is essentially they will go around and pass the hat to all the members of the clearinghouse and say, look, we had a large default. It's depleted our insurance fund, right? We need you to pony up, right, to make this up so we as a clearinghouse don't fail. That doesn't work, obviously, in a crypto context, because the whole premise is that it's like decentralized peer-to-peer,
right.
right? But his point was like, look, actually, that kind of level of intermediation in traditional financial markets almost acts as like a shock absorber or a buffer and gives the market time to settle down and calm down. And it doesn't result in these people getting liquidated out of their positions in the middle of the night. And he gives the example of a farmer, right? If a farmer has a hedge on, he doesn't want to wake up in the morning to see that his position was auto deleveraged or auto liquidated, right? So, look, there are pros and cons here.
Yeah.
And I think we all just need to stop for a second and think about, is this the future we want? Real time, 24/7 margining and trading. And what are the downsides of this? Because we're just sort of rushing into this world, Jimmie, without giving it a lot of thought.
Yeah, I mean, there was a book that Mike Lewis wrote a couple of years ago,
Flash
Flash
Boys.
Boys,
Yeah, great
and
book.
you knew where I was going with that, right? And
Good
it
reference.
basically chronicled the development of the high frequency trading and markets operating in microseconds, and that's how markets operate, is in microseconds now, and so. The idea of being able to slow things down is very, very difficult to absorb. As you said, most clearinghouses are mutually owned, and all the members. Not only do you have deposits every day, but you also post bonds every year, and you get kind of an allocation. Hey, you need to post a bond for X amount, and those are used, as you said, as shock absorbers. In markets where you don't have those kinds of functions, and where you don't have guarantees on settlement, and those kinds of things, there is very little alternative really to what happened. I mean, we have to, there has to be a way for the exchange to continue. And so this is the best mechanism right now. Could there be other mechanisms? Yeah, but it would go against the DeFi kind of protocol. And so I think you have to be cognizant of the fact that these are not the same markets. You cannot say, "Oh, DeFi is just like TradFi." It's not, folks. It's these are night and day. It's not like going from the New York Stock Exchange to the Chicago Stock Exchange.
Fair point.
That's not a good analogy. It's like from going from the Chicago Stock Exchange to a farmer's market. That's what we're talking about. I mean, it really is.
That's a great analogy. That's a
and
good
so,
one.
and so there are different kinds of so they have to have different kinds of tools to do this.
But these tools are not disclosed, though, Jimmie, and this is the issue. And these things might not be as decentralized as people think, because the exchanges, both Sexes and Dexes, did not acquit themselves well in this recent episode, because this is another point Don Wilson makes, which is exchanges are supposed to be exchanges. They just match buy and sell orders, okay? But what seems to have been happening is that some of these exchanges were liquidity providers on their own exchange. We're essentially making markets on their own exchange. And what happened is that when the volatility ramped up after President Trump's post, the market makers they went away. Right? They said, we're not going to make markets here. Okay. And that's the right to do that. But including the exchanges, who were, unbeknownst to a lot of people, making markets on their own exchange, they also, some of the centralized exchanges stopped taking deposits. So even if you wanted to replenish your margin account, they were not letting you do that. Right. So they were just saying, sorry, we're shut down. And some of these exchanges appear to have made money off of these auto deleveraging. So, these things were operating in a way that was clearly a conflict of interest, and not, and this brings me to my final point on this point. Binance, right after the fact, says, oops, sorry, we're now going to launch a $400 million program to should at least help out some of these folks who got auto deleveraged. Right. I mean, can you imagine if, like, the New York Stock Exchange says, oops, sorry, we screwed up. Here's $400 million.
I saw something very similar to this in the oil markets a couple of years ago. I saw something very similar, and they didn't make anybody whole.
This can happen. Look, you make a great point. This can happen. But oil going negative, okay, and that was the pandemic, right? I mean, so extraordinary events do happen in markets, and it leads to this cascading, sequence of events, as we saw. But a president social media post should not result in this level of chaos.
This is true. This is true. This is true.
I got you agree on one point here.
Okay. Yeah. So I know we have to wrap here very soon. We should talk a little bit more, though, about, I think on a future podcast, a little bit more about how some of these markets operate and the differences.
Your world. Yeah.
It is kind of my world. I love talking about it. I love the dynamic nature of it. But these markets are different. We should talk about that, the kind of the structure, because the structure bill's kind of frozen right now. We should talk about that on a future podcast.
We'll all go to class and listen to Professor Lenz.
There you go.
All right, Jimmie. Have a great weekend, my friend.
Hey, you do the same. Thanks, Lee.